You set your stop loss right below the lows. Safe, textbook, exactly where they teach you. And then Bitcoin spikes down, grabs your stop to the cent, and reverses straight back up without you. That is not bad luck. That is a liquidity sweep. And once you see it, you can never unsee it. I am the order flow sensei, and this is the exact trap I hunt with my own real money on Bitcoin. Let me show you how it works. First, the concept. Every stop loss is an order resting in the market. When thousands of traders all put their stops in the same obvious spot, just below a recent low or just above a recent high, that cluster of orders becomes a pool of liquidity. And big players, the ones moving real size, cannot just buy $10 million of Bitcoin without moving the price against themselves. They need orders to fill against. So where do they go? Straight to the pool. They push price into your stops. Your stops trigger as market sells, and that flood of selling gives them the liquidity to buy. You getting stopped out is literally what fills their position. That is why it feels personal. In a way, it is. The market is not random here. It is engineered to take the obvious money before it moves. So why does this keep happening over and over? Because human behavior never changes. Beginners are taught one rule: put your stop below support. So everyone stacks their stops in the same place, creating a magnet. Price does not get pulled toward fair value. Price gets pulled toward liquidity. Equal lows and equal highs are not support and resistance to smart money. They are targets. A row of equal lows is just a sign that says, free stops, collect here. Now, how do you actually identify a sweep instead of a real breakdown? 3 things. Number 1, you need an obvious level. A clear swing low or swing high that everyone can see, ideally with equal lows or equal highs sitting right at it. The more obvious it is, the better the bait. Number 2, you need the wick. A real sweep pokes through the level and snaps back, leaving a long wick beyond it. The body of the candle closes back inside the range. That rejection wick is the footprint. And number 3, you need the reversal to be fast. A genuine sweep reclaims the level quickly and shifts structure the other way. If price breaks the level and just keeps going, that was not a sweep. That was a real break. Patience tells the difference. Here is how I trade it with real money. I do not chase the wick down. I wait for price to sweep the level, then I wait for it to reclaim that level and break the short-term structure back in my direction. That break of structure is my confirmation. My entry is on the reclaim. My stop goes below the very tip of the sweep wick, because if price trades back beyond that low, the sweep failed and I am wrong. And my target is the opposite liquidity, the resting stops on the other side of the range. Sweep the lows, target the highs. That is the whole trade. Let me make it concrete with Bitcoin. Picture the 4-hour chart. Price has been grinding sideways and it leaves 2 clean, equal lows. Every retail trader watching that chart tucks a stop right underneath. Then comes a sharp drop. Price slices through both lows, triggers that whole pile of stops, prints a long red wick. And within a couple of candles, it is back above the lows like nothing happened. That wick below the equal lows, that is the sweep. The reclaim above them, that is your signal. Anyone who shorted the breakdown just became the liquidity for the move up. Now the mistake, and this is the one that drains accounts. Do not trade the sweep before it confirms. When you see price spiking into a level, the temptation is to instantly counter-trade it, to catch the exact bottom. But you do not know it is a sweep until price reclaims the level. Sometimes a break is just a break, and Bitcoin keeps dumping. If you front-run it with no confirmation, you are not hunting liquidity, you are becoming it. Wait for the reclaim. Wait for the structure shift. The confirmation costs you a few ticks of entry, and it saves you from every failed sweep that turns into a real breakdown. So let me tie it together. A liquidity sweep is when price runs the obvious stops above a high or below a low. then reverses. You identify it with three things: an obvious level, a rejection wick through it, and a fast reclaim. You trade it by waiting for the reclaim and the break of structure, entering on confirmation, stopping below the wick, and targeting the liquidity on the other side. And the cardinal rule: never front-run a sweep before it confirms. Stop placing your stops where everyone else does. Once you understand that price hunts liquidity, the whole chart reads differently. Those wicks that used to confuse you start telling you exactly where smart money is stepping in. This is the trap I stalk on Bitcoin with real money every single week. If you want to see me take these live with actual size on the line, subscribe and follow the series. Next, I am breaking down kill zones, the specific hours when these sweeps fire. Stay patient, stay dangerous. Sensei out.